instantly accepted anywhere, spendable as cash, and 100% safe. Get the best-known checks in the world, instantly acceptable traveler's checks.
So I carry an American Express card, the one card I need for travel and entertaining, for business and pleasure. But without this...
In the 1960s, American Express was a name everybody trusted. It was the one card you could use anywhere you went in the world, the traveler's check that never bounced, the most recognizable American brand since decades. And then, something happened in 1963, which caused American Express's stock to crash by more than 50%. And it all started with salad oil. This is the story of how one con man landed American Express in the biggest financial scandal of the 60s, and how American Express lost almost $100 million because of a casual mistake. It's also the story of how Warren Buffett used this as an opportunity to turn American Express into one of his best investments by observing what nobody else saw. Watch carefully till the end, because it's a lesson to all investors about why the news can be misleading and what you should pay attention to instead. Our story starts with a commodities trader named Tino De Angelis. He had a shady past and he wanted to make money fast. Tino had earlier tried to sell school programs low-quality beef from uncertified sources, and for this he had been banned from government programs. But he found a way to bypass this by starting a company called Allied Crude Vegetable Oil Company. Let's call it Allied Oil for short. This company struck a contract through the US government's Food for Peace program to trade in the market for soybean oil. Soybean oil was also known as salad oil. Ships full of salad oil would dock, inspectors would certify the tanks in Allied Oil's warehouses, and Tino would borrow money using the oil as collateral. Seems fair enough. The catch was that Tino didn't actually have the oil. All of his tanks, which could hold tons of liquid, were actually filled with seawater, and there was only a thin layer of oil floating at the top. But the inspectors who were supposed to verify his stocks were casual in their process, and they issued receipts without checking the tanks thoroughly. At one point, Tino had borrowed $180 million in loans, but the collateral he had in his warehouses were worth only $11 million, less than 6% of what he claimed to have. Tino thought he could run this scam indefinitely, but one morning, the Russian soybean market failed to open. Investors made a run to liquidate their stocks, and when the inspectors turned up, it turned out that Allied Oil didn't actually have the oil they claimed to have. Here's where American Express comes in. The warehouses in which Allied Oil had stocked the salad oil belonged to American Express Warehousing Limited, which was a subsidiary of American Express. The inspectors issued receipts worth about $60 million, and American Express was on the hook to pay back this money. They were in big trouble because they didn't even have all of the cash to cover their liabilities. But the company's president was promising to pay back all of their debts because he knew that for American Express, protecting its reputation was the most important thing. But investors were panicking. On November 22nd, the company's stock fell from $60 a share to 56.5, and then the president, John F. Kennedy, was assassinated. When the market reopened, American Express stock had fallen to 49.5. By early 1964, the stock fell to 35, almost 50% of its value in November. Everyone thought the American Express story was over. A random mistake at a random time had cost the company its future. But all this time, one person was silently buying up American Express stock. While everyone else was panicking, Warren Buffett was doing his own research. American Express hadn't missed a single dividend payment in 94 years, but now people were claiming that it was about to go insolvent because of a single day's event. To check if this was true, Buffett didn't go to Wall Street. Instead, he went to Ross's Steakhouse in Omaha. Buffett sat near the cashier, made small talk with the owner, and waited to see just one thing. After having their meal, how were customers paying their bill? Buffett's hunch was right. Customers were still using their American Express cards to pay for their dinners. Scandal or no scandal, the company still had the trust of its customers. That's all Buffett needed to know. If people in Omaha were using American Express cards, people in St. Louis, Chicago, Birmingham, and all over the world would be doing the same. Next, Buffett visited banks and travel agencies and found that there was no change in the travelers' checks sold by American Express. He went to supermarkets and drugstores that sold American Express money orders, and it was the same result. He even went around talking to the company's competitors to see what they thought. Buffett's conclusion was that people were overestimating the impact of the salad oil scandal on the company's long-term performance. American Express's most valuable asset was its name and its mind share among its customers. It held 80% of the travelers' checks market and a big share of the cards market. That market share and mind share was still unshaken.
American Express, an interesting case study. We always think in terms of share of mind versus share of market, because if share of mind is there, market will follow. American Express had a very special position in people's mind about financial integrity over the years and ubiquity of acceptance. When the banks closed in the early 30s, American Express travelers' checks actually substituted to some extent for bank activity during that period. The worldwide acceptance of this name meant that when American Express sold travelers' checks, and despite the fact that American Express charged you 1% when you bought your travelers' checks, and you had two other premier organizations, Citicorp, imagine, and B of A, American Express still had two-thirds of the market after 60 or 70 years, two-thirds of the worldwide market, while charging more for the product than these other very well-known competitors charge. Anytime you can charge more for a product and maintain or increase market share against well-entrenched, well-known competitors, you have something very special in people's minds.
In the 10 years prior to the scandal, American Express had earned record profits in every single year. It was still a solid company based on its fundamentals. But the market was acting as if its customers would all leave overnight. And Buffett personally verified that nobody was leaving. While the entire market was panic selling American Express stock, Buffett was actually buying more of it. Buffett didn't just say, "Be greedy when others are fearful." He was actually practicing what he preached.
And you could see this dominance prevail. That told you what was in people's minds. It's why I bought into the stock in 1964. We bought 5% of the company for a huge investment at the time for us. I was only managing $20 million at the time. But you could see that this share of mind, this consumer franchise, had not been lost.
He supported Howard Clark, the company president, who was trying to compensate the warehouse creditors for the $60 million they had lost to Tino, while shareholders were suing the president for wasting money. Buffett personally testified in court, saying that the $60 million payment was like a dividend paid out early, and he held on to his own stock for years. This was one of Warren Buffett's biggest bets. At one point, more than 40% of Berkshire Hathaway's assets were invested in just one company, American Express. But Buffett never revealed this investment to his shareholders for years to come. When he exited American Express in 1968, 5 years later, the company had grown to 5 times its original value. This entire salad oil scandal and Buffett's approach to investigating it is a reminder that sometimes the news and the market overestimate the impact of an incident on a company that has sound fundamentals, and that the things that you should be looking at aren't the stock price but rather at the mechanics of the business and whether customers are still buying what the company sells. Here's a piece of trivia though. Since 1968, the value of the company has multiplied by more than 17 times. Buffett did buy back into American Express in 1998 and he owns about 21% of the company now. But if he had just held on to his original investment, he would have made a much greater profit. On our blog, Market Sentiment, we have written in much more detail about paying attention to fundamentals for long-term investing and coffee can investing. The link is in the bio. Do check it out and please share this with a friend if you found it interesting. If you found that interesting, please like the video and share it with your friends. At Market Sentiment, we are trying to make content that will make you smarter investors and teach you all the basics of the stock market. Likes and subscribes are the only way a small channel like us can grow, and it would mean a lot if you like, share, and subscribe. It's going to save you hours of work and make you a smarter investor.